Hi everyone, this is Joel Mallow, branch manager with American Financial Network. I wanted to put this video together for homeowners who are currently in an FHA mortgage, paying mortgage insurance, who wanted to explore their alternatives or options for removing mortgage insurance. In fact, the video is really going to go over the benefits of eliminating mortgage insurance and why you should highly consider getting rid of it if you have the option to do so. Now, keep in mind that there is another video that we also created where we take you directly to the HUD website. HUD is basically in charge of writing all of the guidelines, rules, and writing FHA loans. And the reason why we created this video where we take you to the HUD website and walk you through the rules and guidelines is because of a lot of homeowners are misinformed or didn't understand completely the rules of an FHA mortgage or the mortgage insurance when they originally got it. It also could have been that the loan officer who did the loan originally didn't explain it thoroughly. In fact, a lot of homeowners think that after only 20% equity in your home that your mortgage insurance falls off. That is not true, and you'll see that in the other video. The other thing that homeowners think of is after 3 or 5 years, mortgage insurance falls off. And that is also not true, which is why we created the prior video. In fact, on that video through HUD, you'll come to realize that mortgage insurance typically does not fall off for 10 to 11 years from the time that you originally took out the loan. So on this option and in this video, keep in mind it's just an example of a homeowner who has an FHA mortgage and his option in eliminating that. So this is only an example, but it's very similar to the ones that we create for hundreds of homeowners that are in the same position you're in, looking at what their options are to get rid of this mortgage insurance. So in this scenario, this homeowner bought this home for $342,000 just over a year ago, about a year and 6 months. And they bought it for $342 with the money down. They financed originally about $335, and they currently owe about $326,297. At the time, the homeowner got a 4% interest rate, but their payment is $1,952.78 because it's including that mortgage insurance. So one of the things you want to keep in mind as a homeowner who has FHA mortgage, not only are you paying this 4%, but FHA loans also charge a percentage for mortgage insurance, and that mortgage insurance, depending upon when your loan was originated, could be as low as 0.55 to as high as 1.35%. And that's tacked onto your existing interest rate. So a lot of you may think that you're paying a 4% or a 3.5% when in all actuality you're paying a 5%. A 5.25% or a 5.5% when we factor in that mortgage insurance percentage that's being added to your loan. In fact, it's even higher than actually paying a 5.25% or 5.5%, or worse, you can say, because none of that money that comes from mortgage insurance gets applied towards principal and interest at all. None of it gets applied towards principal and interest, yet you're still paying it every single month. So what we wanted to do is we wanted to take that same existing balance that homeowner owes, and rates right now, give or take 4%, they've been as low as 3.75, but depending upon where the market is, I think 4% is a good range that we can look at. So we're basically taking what they owe now, their rate, and this loan, giving them a comparable rate. But look at what the payment is now without that mortgage insurance. This homeowner is saving about $394 per month. Now, you can do two things with that. You can either pocket that money every single month and enjoy the savings, enjoy the benefits of utilizing that extra money or paying off maybe a credit card. But what we'd like to do is, if you're already currently in this FHA mortgage, you still have 28 years left in it, and we already confirmed that FHA mortgage typically takes 10 to 11 years, some even as high as 12 years to fall off with the mortgage insurance. Why not reapply this savings back into the mortgage for the same amount of time that you have left paying mortgage insurance. So that's where we'll look at it here. Excuse me. In this option, we are saying currently based on what you owe or what you originally had financed, what you owe at this rate paying $19.52, you still have 28 years left on the mortgage, and your mortgage insurance here, MI cutoff, is not going to fall off for another 9.58 years, as we originally said, anywhere from 10 to 11 years. Well, what if we applied that $395 that we're saving per month and we put it right back in for the same amount of time that you have left here? What would that really do to your loan? Well, it's pretty huge. You would pay off your loan in 24 years versus 28, which you have now. So that's 4 years that you would eliminate worth of payments. Now, if we did that math, let's give or take, let's just take the minus the mortgage insurance. So $1,500, just use a roundabout number instead of, rounding up here. So let's just use $1,500. But if we're eliminating 4 years, we're going to take 4 years times 12 months in a year. That's 48, and we're going to times that by that $1,500 that we're getting rid of now for these other 4 years. It's $72,000 in savings just from redistributing the same money that you're paying now, but putting it back into the principal on your new loan. And we're not asking you to do it forever. We're asking you to just put it back in for the same amount of time you're going to continue paying mortgage insurance. Again, you don't have to do it. You can pocket that money every month, but we want to show you that there's huge benefit here in being able to save $72,000 just by redistributing the money. Now, that's not it. You're also seeing savings here just after 15 years. If you stay in the loan that you're in now, you're going to continue to pay mortgage insurance in this scenario for another 9.58 years. But you're also going to pay $199,471 in total loan balance for 15 years. Whereas on the new one, you're only going to pay $148,005. So again, let's look at that math. You have $199,471 minus what you're going to be paying on the new loan, $148,005. You're going to be saving $51,466 plus the $78,000 from the 4 years that you're eliminating here, which we did the math on earlier. So that's a total savings of $129,466. And you're simply removing mortgage insurance, reapplying the savings only for the amount of time that you would have continued to pay mortgage insurance, and you're creating a savings of almost $130,000. Now, that it's pretty much a no-brainer, which is why we have hundreds of homeowners doing this when they qualify for the option based on what they want to get done. But as you can see, there's a $395 month savings per month. Just within the first 60 months, within the first 5 years, you're already saving $23,000. Again, over the 15 years, as we mentioned earlier, it's just north of $50,000. That's that comparison here. If you paid here for 15 years on the current loan, or you paid on your new loan here, it's $142,000, significantly less, a ton of savings. What we like to do is we like to gather all of your information based on your existing loan. I like to structure these specifically, one of these presentations specifically for you and your family, so that you guys can really discuss your options and figure out what's going to be most beneficial to you. But we have hundreds of homeowners that we help out that we're able to do on a monthly basis, and they're able to really digest the information on one of these presentations and see how the numbers work and their benefit. If you'd like to get a hold of me, you can reach me directly on the numbers that are provided up here at the top, as well as the email address. I'll be more than happy to answer any questions. Again, I hope that you've seen the prior video where we validate all of the rules and guidelines for how mortgage insurance truly works. And we hope that the video has been helpful in enlightening you a little bit about your options and what you can possibly do with that money that you're basically throwing away, because you can do a lot more with that mortgage insurance money if you just redistribute and restructure your loan. We look forward to helping you and hearing from you. Again, have a wonderful day, and we'll talk to you soon.